Hi there, Mark Anderson here, mortgage banker at Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. This week has been a very, very crazy week, which followed last week, which was a very, very crazy week, and the week before that, and I think maybe even the week before that. The story in a nutshell for this week is that the window of super low pricing opened back up. We saw rates that touched almost as low as the levels we got to at the start of this whole crazy low rate refi boom that happened earlier this month. There is something very interesting, though, about I'm going to call it the divorce of the fundamental drivers of mortgage rates and the reality of mortgage rates. And this is a theme I've touched on in many of these videos. But this graph here is the last 3 months of bond prices. Now, as a reminder, when bond prices on these mortgage bonds are high, that's what causes rates to go low, typically. But what was going on this week was very atypical. And I'm going to make an argument in this video that may be wrong, but it's my impression. And I think that there's some experts that agree with this, that we are at a point now where the fundamentals of high bond prices equals lower rates, those fundamentals aren't really making sense in the way that they normally would. What we've got here, if you go to this peak right here, March 6th, down into earlier in March, right about here is when we had the best interest rate opportunities. There were a couple other times after that date, but right around this early March window is when the rates first just shot down very, very low. Then we had a fall off. Pricing got worse. Then we had another small opportunity window open again. And then the rates came up again. And this is this week. We have shot up dramatically. And the reason I blew this chart out to 3 months was just to show you how dramatic the change is, not only in terms of the angle of that slope, but also just in terms of relatively how high these bond prices are now to where they were, say, at the end of 2019. Overall, the rates this week were very, very low. They were almost as low as they were here. But if what I always say, that when bond prices go up, rates go down, is true, then why are rates here at this level not better than here at this lower bond price level? Now, I've made reference to capacity issues a few times during my time working on these videos. And that, I think, right now is the fundamental driver behind why these high bond prices are not currently translating into pricing that's better than what we had in this window here. The thing that got this whole party started this week for the rates coming back down was this Fed program where they're dumping tons and tons of money into the mortgage bond market to solve some liquidity issues. And while it has worked to drive up the bond prices, and while the rates this week were very low, I think that what we might be seeing here is what I have referred to many times over, and I remember back in 2012, I referred to this as there is a technical bottom end that the rates really aren't going to fall below. Now, I could be wrong about this, but what I'm seeing here it makes a pretty solid case for my theory. The lenders over the last 3 weeks or so have taken truly unprecedented amounts of loans onto their books. There are already stories of lenders that are shutting down refis entirely. There are some competitors out there that are having to lock their loans on 120-day locks, which I can't imagine telling a client, well, we're going to lock now. I'll see you next season to close your loan. It's just bizarre. But there really is a true limit to the amount of capacity that this market can bear. There are human logistics involved with serving the behind the scenes work that goes on to getting these loans done. And I think that that is one of the fundamental reasons why these rates haven't gone lower. My argument is that I think pretty strongly that we're at the bottom end of where these rates can go. So my case to you is that if you are in a position where refinancing makes sense, I don't think it makes sense at all, not one bit, to wait around. For all I know at this point, the bond market may fall off the cliff on Monday. I don't think that's going to happen. But even if the bond prices continue to go up, we already have not seen the rates come down in a way that matches how much the bond prices have gone up. And if that's not an indication that there is a floor to where these rates can go, I don't know. I feel pretty strongly that at this point, the best, safest move is to lock. Rates are super, super low. I'm happy to take a look at your scenario. I will say this week, I fell off the track here. I did not do a video yesterday. And the reason I did not do a video yesterday is that, candidly, I have just been swamped, I think is the technical expression for it. I have spent a lot of time responding to quote requests from past clients, from folks that I've met through doing these videos, and I've done my absolute best to get with everybody. What I'm going to recommend, especially as volatile as things are right now, whether you're working with me or whether it's somebody else, there is a back and forth of, okay, email me a proposal. Well, by the time I look up the rate, email you the proposal, you take a look at it, you talk to the wife, you talk to your husband, you get back to me. In a lot of cases, the rates are different in some way by the time you get back to me. So what I have started doing is really insisting on, let's jump on the phone when you're free. Let's price out your scenario in real time. And let's make a decision at that point whether you want to lock. I'm not going to be pushy about it. I'm not a pushy sales guy. We'll take a look. I'll let you know exactly what you're going to pay, what the interest rate is for your scenario, and we can determine whether or not you want to lock. The question that I always get is, well, Mark, what do you really think is going to happen? And I've been a little bit cagey in this video series about answering that question. I've oftentimes said, well, we really don't know. I'm going to go ahead and make a bet here that in general, as I said before, I think the time to lock is now. I don't see these rates falling lower for the reasons that I've mentioned related to capacity. There's some more technical reasons for that as well. Some of the concerns that these big institutional lenders have about the amount of loans that they're taking on in the context of a situation where some borrowers are going to be going into a 6-month period of not paying their mortgages. There's a lot of uncertainty. There's a huge amount of loans in the system. And so I really do think that the time to lock is now. Well, I feel like this video has been a little rusty, been a little rambly, but it has been a very, very long week. Again, I thank everyone who has reached out to me that I've met on YouTube. I would love the chance to talk to you. Thank you very much.